Hi there folks, it's James Marley here and welcome to our listed series for 2026. I'm sitting down today with Kanish Chugh, who is Head of ETF Sales at PIMCO. We're going to be talking about their latest product, Earn, which is listed on the ASX, and it is the PIMCO Short-Term Active Yield Active ETF. Now they say cash is king in markets. Kanish, with Earn, I think you guys are looking to go a little bit better than cash. Thanks for sitting down with us today and good to catch up.
No, thank you for having me, James.
What was the rationale behind bringing Earn to market?
Yeah, so the rationale for PIMCO across our broader ETF platform is really to try to bring institutional grade strategies to the broader Australian investment universe and market. So, a lot of our strategies have been accessed by institutional clients, a lot of the advice-based clients as well that we have across Australia. And PIMCO has been around in Australia for over 26 years now, since 1999. But really, we felt that there was an opportunity to bring to market those institutional grade qualities. And with Earn specifically, we look at Australian portfolios with where yields are at the moment, where rates are, with how volatile markets have been over the past number of years. Cash has been a very heavy dominance in Australian portfolios. And Earn for us sits between traditional cash allocations and longer core fixed income strategies. So from that perspective, it really fits a nice sort of unique spot within portfolios that we felt was missing from our suite of products, but also for all Australian investors to try to access something that was just a bit of a step away from cash.
Okay, you mentioned it there, interest rates, bond markets, there has been some volatility. How do those dynamics shape the opportunity set that you're looking to capture with Earn?
So the Earn ETF is effectively targeting a 0.75 to 1.25% above the RBA cash rate gross of fees. So that's sort of the target alpha that we're looking to achieve above that benchmark. Now, it looks to do that from very much a highly investment grade, so low credit risk opportunity set. Now, when we look at that, you talked about where yields are at the moment. It's a unique point in the market. Yields have been at sort of highs that we haven't seen in the past few years, from that post-COVID period.
Yep.
The other thing to consider is central banks are actually quite diverging in terms of where local central bank is policy and where offshore, the US, Europe and other countries.
We're the outlier, unfortunately.
We're the outlier at the moment. That's definitely the case. I think from where we sit is, for investors, where they can make their cash work for them. And for us, Earn sits in this unique spot. It sits in that unique spot in terms of providing that elevated step away from cash. It sits in that spot that it's not looking to take interest rate exposure, but being short term. So its max duration within the portfolio is 1 year. Current duration in the portfolio, as at the end of February, was sitting at about 0.3 years. So from that perspective, that interest rate sensitivity that it has is relatively low. Now, obviously, when you look at core active fixed income allocations, of which PIMCO, we have a number of those strategies, exactly right. We use duration as a way, and we use sort of that interest rate exposure as a way to diversify portfolios and as a way to add alpha within those specific strategies. So I think that's really important to consider from that perspective. So Earn sits as a complement to longer duration fixed income strategies that are more core within portfolios. It also sits as a way to allow investors in a more liquid setting, being an ETF, to access something that's just a step away from cash.
Yep. Let's just stay with that for a moment. Cash, if we take that as the closest thing to risk-free.
Yes.
Earn is a step above. You get compensated hopefully with a higher yield.
Yes.
But with those dynamics in markets, shifting rates, uncertainty, how do you manage volatility and the different risks that are out there within that Earn portfolio?
Yeah, I think it's a crucial thing, especially from a PIMCO perspective, where for us, clients is at the forefront of everything we do, and we are managing money on their behalf. So from our perspective, the way in which we manage Earn and the portfolio that it runs is it's investment grade only exposure. So that's really important. From a credit risk perspective, the current credit quality within the portfolio, as at the end of February 2026, was sitting at AA rated. So, high credit quality. We're not looking to go out that sort of on the risk spectrum to try to generate high yields. To the point where what are the three things that Earn is trying to achieve for clients? It's capital preservation, it's a step away from cash, and it's liquidity. So those three things, we're not trying to generate large amounts of alpha above, or large amounts of return, I should say, above that RBA cash rate. I talked about that target range of return that we're looking to achieve. And that's something there where we don't want to take highly elevated levels of interest rate duration or interest rate risk or sector risk or credit quality risk within the portfolio. So investment grade only, max 1 year duration is really the key tenet of the portfolio. And as I said, it's all about providing an exposure that gives clients that ability to have some capital preservation, but and step away from that cash that you talk about.
You've touched on it a bit there, but just how sensitive is earn to movements in short-term interest rates?
Well, relatively limited, given the current duration is 0.3. We can step up to 1 year duration. So I think the key factor of earn is also a 50% Aussie dollar denominated bonds exposure. So minimum of the portfolio will be focused on Australia. But PIMCO, as we spoke about, it's a $2 trillion US manager. We manage portfolios across the world. We've got expertise and insights, from whether it be looking at the European market, the US, the Asian market, in Japan. So we want to have that ability to step away should the opportunities arise. We talked about where central bank policy is. We've got that ability, should we need to, step away from Australia. Currently, the exposure to the Australian market in the portfolio is sitting at about 70%. Right. So from that perspective and that lower duration that sits at 0.3, so obviously the higher the duration, the more exposure you have to interest rate moves. Obviously for us, we're not trying to generate performance within this strategy from moves in interest rate. What we're trying to achieve there is something that just sits above that cash rate. And that's why we're looking at that shorter term duration. So effectively, whatever the interest rates are offering, so more of a floating rate style exposure.
Yeah, I shudder to say it because higher rates for most people at the moment is potentially more on the mortgage.
100%, yes.
Sort of stuff. But I imagine that higher rate starting rate position, it's probably a good thing for what people are going to be able to achieve in terms of returns via earn.
Exactly right. I think, when I looked at the yield to maturity, so effectively, what's the forecast potential return that this portfolio could achieve? The yield to maturity, as at the end of February 2026, was sitting at about 4.6%. Where cash rates are about 3.85, so it's still sitting at above, close to 0.9 above that cash rate. Yep. So that's sort of where we sort of see this portfolio sitting, is it provides the ability for a client that, if they would take, there are money market strategies that they could look into. There's the cash accounts that they could take. Some banks offer sort of in and around cash. Some offer just slightly above, slightly below, depending upon the bank that you're with. And obviously term deposits have some element of illiquidity premium that's attached to them. Yeah. So what we wanted to offer was an alternative to that. What we wanted to see is this isn't for a client's entire cash or allocation. It's a step away from that. It sits as that sort of interim between their longer duration core fixed income strategies that they may take and that traditional cash or money market strategies that they may have. And I think another key important factor is, we've got experience in this space for over 30 years. So we run over $140 billion of money market and short-term instruments globally for institutions, wealth clients around the world. So we're looking at this from that global perspective. Obviously, this particular strategy is also managed by a local Australian team as well. So we've got that local perspective with that global experience.
Okay. Well, we're here at the ASX, talking about exchange-traded products.
Yes.
Why is the ETF structure suitable, or why did you bring earn to market in the ETF structure?
So obviously within ETFs, you can access now pretty much a lot of different asset classes. And, for us, it's important to consider that we want to bring to market an institutional grade strategy, but offer it to every Australian investor. What that means is we're now bringing these types of strategies that, that we've offered to institutional clients, maybe even in our unlisted managed fund form as well, into a structure that every Australian investor can access. It also provides an element of liquidity. From their perspective, from a client's perspective, they can now access this product on the market. They can trade it as they would their CBA or BHP or Telstra share. So that makes it really accessible. And so for a client, an advisor that wants to allocate to this particular strategy via in their portfolios, they can now do so in that listed structure.
Well, Kanish, thanks very much for coming in and talking to us about the PIMCO short-term active yield active ETF. I think its ticker earn is going to be far easier for us all to remember.
No, thank you for having me.
Hi folks, I hope you enjoyed that interview with Kanish Chugh from PIMCO. Remember, you can check out all our listed series content on our YouTube channel. It's dropping throughout March.